Have you adjusted from being in a different time zone yet? I mean, you were on the other side of the planet for a while.
Yes. No, it's really odd in my household right now, just because everyone's times are off. We're all going to sleep before the sun's even, the sun's still out when we're going to sleep, and it's.
Wow.
I went home yesterday. My kid was like laying on the floor asleep, and then I actually went out and played pickleball in the heat, and then came back and he was sleeping, so he completely missed dinner.
Wow.
And then my other kid laid next to me at like 6:30, and he fell asleep, so I had to carry him to his bed. And like by 7 o'clock, all of us are just struggling. Like I try to power through. Like I'm like the one that's able to stay up the latest, and like I'm talking like 7:30, and I'm like, man, if I could just make it to 8, if I could just make it to 8,
it's a real scene.
It'll be progress. And
so
by the time 8 comes around, I'm like, no, I'm gonna go. I'm in bed. Like I want to be.
Well, what is Italy time relative to Pacific's?
9 hours difference.
9 hours difference.
Yeah.
That's rough to recover from.
Yeah. So when you should be going to sleep, you were waking up there, so it's like you should be waking up, but like, you were at least rested, and now you're at the end of your day. It's just, it's a bad mix. But
well, hopefully you're well caffeinated and ready to do one of these, because it's been a little while.
I'm like every day. This is day 4. Like every day has been good up until about 6 p.m. So I know it's coming, but like work is perfect. Work is perfectly fine.
So I've got you for like 2 more good hours.
Yeah. We were doing this later.
That long.
We were doing this later. I'd be in real trouble.
Real tough. Okay. Before we go dig into, we're going to talk markets, of course, per the usual, and make sure that we're touching on all of the important things. But first, did you know July is, oh God, I just had it. July is National Grilling Month. And we're right at the end of, we have one more, as we record this, one more trading day in June. So July, National Grilling Month is upon us. Do you do a lot of barbecuing?
No, we have.
Do you ever barbecue?
No. So
zero.
We moved into this house 3.5 years ago, and they had this built-in barbecue in the backyard. I have never used it. I'm not the cook in the house, first of all, so I like a little deferred that. And I know that barbecuing tends to happen in the summer, and I just never understood. I'm probably the outlier here. I just never understood. It's going to be 110 degrees next week, and if I was out barbecuing, why would I want to be outside in front of the heat in the heat? Like it just makes, like, I get you. People will say you can jump in the pool, but I don't want to be next to something hot in the middle of the heat. So I'm like, if I were to barbecue, maybe it'd be in the fall or the winter. But I gotta admit, I'm not a barbecuer.
Well, barbecuing before a football game or whatever is awesome. But I think a lot of the reason why barbecue is going on during the summer is because no one's heating up their kitchen, baking a casserole in the oven when you're in the middle of summer, right? You keep the heat on outside of the house. So you barbecue.
That's a good argument. That's a fair argument. I just don't want to be the one out there sweating on the food while
doing the dirty work.
While it's hot outside.
That's fair. Okay. Well, at least you own a barbecue.
Yeah, but I do get it. I get why there was picked July for National Barbecue Month. So I get it.
Hot dogs, hamburgers.
It's probably every other thing has a specialty, National something month anyway. So.
Well, it's marketing, right?
Yeah.
It's marketing. And so it makes sense. 4th of July barbecues going on during the summertime. So that's probably, I don't know if it's Weber Barbecues or the Charcoal Company or whatever the hell it is. But
somebody lobbied for it.
Somebody lobbied for it. It's not a national holiday yet, but stand by. All right. Well, you're back in this country and in this time zone. It's been a little while. You ready to check in and do this thing?
Okay. Yeah, let's start this.
All right. Welcome back to the financial. I did it again. Welcome back to the Casual Friday Financial Insights podcast. I'm Brian Ullman. I'm a financial advisor here at Ford Financial Group, joined by Ryan Louie, also a financial advisor here at Ford Financial Group. And if you are new to listening to this, I would urge you to subscribe if you're listening wherever you listen to podcasts, Spotify, Apple Podcasts, and so on. Or if you're watching us on YouTube, subscribe to our YouTube channel. We update this regularly along with other videos that complement these. So you can kind of get our take on what's going on with markets, financial planning, retirement planning, and the sort. Ryan, while you were gone, in part
the
of
markets were up.
What's that?
The markets were up.
Markets were up. So you need to leave again.
Yes.
We were on, I would say, a pretty solid run while you were away. It doesn't always work that way. It feels sometimes like markets choose to puke and go down when you're away. I just, like, as an advisor.
Yeah, no. I know what you mean.
If I ever stop watching, markets will go down.
I too will keep a sharp eye on things while I'm gone. And I will say it's so much more pleasant when the markets are going up and you're traveling, because it just feels like life is okay back at home when the markets are going up and people are happy, and you're not missing out on anything when the markets are going up.
Right. So we're looking year to date here. Let's just look month to date as we close out June. The orange is the Dow up. Gosh, what's that? 1.25. The S&P 500 up just short of 4% with one trading day left here in June. NASDAQ up 6.75% month to date. Like, good gravy. And of course, those are the mega cap AI tech names we won't mention here. So a solid run. God, if you were to ask me, though, you start looking at valuations, some things are really far out in front of their skis. It wouldn't surprise me. I mean, we've been going up since Jay Powell announced, with the exception of April, we've been going up since November 1st, when Jay Powell announced that interest rates were done going up. But at some point, things have to cool off, right? Markets have to run out of steam a little bit.
Yeah, I'm kind of prefacing this with clients as we're at that halfway point of the year to kind of say, don't expect the stock market to have kind of a repeat of the first half and the second half. And that's just to keep things in the expectations in check. Yeah. It's not to say it can't happen. It absolutely could. It's just, we have had, a very good run up in a portion of the market. I don't think that it's necessarily going to happen at this point, just because I think tech stocks are still running hot, but maybe there's a point where things kind of shift down to where some of the other sectors, the other market cap weighted areas start to perform better and catch up a little bit. That could also happen as well.
That could happen. September historically is the weakest month of the year. So I don't know how many people would be surprised if we got into August and things started to kind of chill out, or maybe we even saw a 5% pullback sometime in August or September, just on the seasonality of it all. We're headed into July. We're going to have earnings season coming up for the second quarter. If growth is stalling out, that could cause things to go down. I mean, there's a whole bunch of stuff, and we haven't even mentioned like election stuff or anything like that. There's a debate going on between the two presidential candidates tonight that I will not be watching. I don't know about you. You'll be sleeping. What are we talking about? But, there's a whole bunch of stuff that can go on. But if seasonality is taking hold, which it seems to have been following that script this year, August and September wouldn't be a surprise if we have some sort of pullback or even full tilt correction. So the yellow on this chart is the aggregate bond index, the AG. Up better than the Dow this month, we'll call it it's 1.38% on the year. And importantly, year to date, if we look, the AG, it just broke below break even, but we'll call this, for all intents and purposes, essentially flat on the year. And that's a little bit of what we're talking about, today, right? That interest rates have been kind of uncertain over the past couple of years because of inflation, economic growth, Federal Reserve. The 10-year yield, for instance, jumped from 3.8% at the end of last year to a high of 4.7% in April, one of the reasons why we had that pullback in April, and has settled in around 4.2%. These high rates have kind of defied the expectations of investors and economists and everybody. So we're kind of looking forward with inflation improving, perhaps interest rates coming down, really kind of supporting the bond market here. And that's really what the topic is today. What's going on with the bond market?
Yeah. I mean, we continue to wait for the Fed pivot, and that's what's made. I think the first, more of the first 4 months of this year was hard because we were thinking that we knew the direction, rate cuts were going to come, and then as kind of the months went by through this year, and the economic data kind of changed less favorably for a cut, things started to change again, and not in a good way for bonds.
Right.
And so again, it spent like the first 4 months of this year kind of reliving what we've been dealing with a lot with these bonds, which is going down when we expected them to maybe start to have the rebound. Now, over the last 4 to 6 weeks, things have kind of changed a little bit better for the bonds, and that's why we're very much close to break even for the year.
Right. Yeah, and what we're looking at, if you're watching on YouTube, the chart we're looking at is these bonds have sectors. I think people know that stocks have sectors or different types of asset classes. So do bonds. And so you can kind of see here, yes, the aggregate as of this is through June 26th, where the ag was down a little bit. It's up a little bit from there, but down somewhere between 0.5% and 0.25% on the year. That's in the blue here, but you can see corporate bonds not as bad. Tips, high yield bonds, emerging market debt, positive for the year. And so the sectors, if you're diversified a little bit, maybe you're not getting hit as badly. Certainly last year, high yield bonds performed well. Emerging market bonds performed really well. So it's not all bad, I guess.
Yeah, I think this is kind of very much just like what you would think in the stock market, right? You wouldn't own just one box, right?
Right.
And so usually when people show this, it's because they're showing that people own very much different areas of the stock market. In this case, they own different areas of the bond market more than likely. And so you're going to have a spread of different returns in there. And it's going to give you a mixture. As you can see, again, for those that can see the chart, that dark blue area is the ag, and you would always kind of expect that to be kind of in the middle because it's a kind of the bond benchmark. It's a mixture of different things, and it's not concentrated just in the riskiest ones nor the most conservative ones. And so it is going to tend to stay towards the middle of the returns of these bond returns.
Right. So I'm going to give everybody a quick bond primer here because this is how you understand how bonds relate to interest rates. Let's say I own a company's bond. We'll call it, I can't call it company X because there's like a company called X now, right? So let's call it company A. I own companies A bonds that were issued and paying 3% interest. And Ryan bought some of those same bonds issued by the company later that are paying 5% interest. Now, you as the listener or watching this want to own company A's bonds. Would you be more interested in owning Ryan's at 5% interest, paying you 5% interest, or owning mine, paying you 3% interest? The answer is Ryan's. You want to get paid more for owning the debt, right? And so as interest rates rise, if you own the debt at a lower rate, you have to reduce the price that you're willing to sell it at to make it equivalent for the higher yields. And so that's a hard way of understanding, but as interest rates go up, the price of your bonds go down because you have a lower yield. As interest rates go down, the price of your bonds go up because people would rather buy that higher yield. And that the reason why it's important to understand that relationship is because as interest rates fall, bond prices rise because the existing bonds are more attractive. The yield on the investment grade bond index is hovering around 5.3% right now, which is well above the average of 3.7% over the past 15 years. So if yields revert to the mean, meaning they're going to go down almost a full 1.5%, then you would expect bonds, the prices of the bonds that everybody owns now, to start to rise. And that makes it so we're not saying one particular bond or even one particular bond asset class, just generally, if you are owning bonds that have higher yields and then yields fall, you're in a really good position for bonds to benefit from that.
Well, there's something to add there too, and just in terms of where we're going to go with these returns, if interest rates go down, because there's a trade-off, right? Some people might, in some ways, just be happy to earn a 5.3% interest in perpetuity, right? Because that is a very healthy yield, and if you're looking for income, it's a good rate that you're collecting. The problem is that when the interest rates go down, when the Fed eventually lowers interest rates, your bonds are going to appreciate in value. So you're going to be happy that your bonds went up in value. The problem is that with that, your yield is going to go down, and maybe it does revert, like you said, it goes down to something, let's say 4%. You got the boost in appreciation and the value, but now you're collecting only 4% versus the 5%. So there is going to be some kind of trade-off that happens as these rates eventually go down.
Yeah. Well, you got caught on the other side of the whipsaw before, where you had really low rates and rates went up. And so not only were you getting crappy yields on your bonds, but also the value was falling because all the new issues were higher.
Yes.
And so why do we think interest rates may go down? Well, the Fed has said so, right? So this is the Fed fund target range. This is the lower limit of their target range. Their target range, the Fed fund's target range currently is anywhere between 5.25 and 5.5. So this is the lower limit of that target. And the Federal Reserve has essentially said that they're sensitive to the two-sided risks of keeping the Fed rate higher for longer. So the high policy rates can combat inflation, but they also slow the economy. It's two sides of the same coin. And so there's some question about whether unemployment has breached the 4% level, right? We might see some growth slowing down. They may cut rates, and markets are pricing in a rate cut this year. And that's why we think rates will probably start.
Yeah, inflation is taming. Core CPI rose 0.2% in May. So that's making things look better on the inflation front to be able to lower interest rates. Core inflation was up 1.9% over the last 12 months. So if you take out housing costs, that's which are number that
right now. Housing costs are whack right now. There's no
yes. And
Zillow says your house is worth a ton, but no one wants to buy it because of
and I mean, I know that it's relevant for some. It's definitely not relevant for a lot of people. If you have a house, your house, you're not concerned necessarily with housing costs, going up or down. Right. And so, that core inflation number being 1.9% is not something that anyone's going to worry and lose sleep about. And that's a very reasonable number. So it does lead to the fact that the Fed may have reason to lower interest rates sooner than later.
Okay, it's time to call your shot. This is it, Ryan. What's the Fed going to do? When are they going to lower rates? How much are they going to lower them by? When are they going to do them? You have a meeting at the end of July. You have the meeting in the middle of September. You have the meeting at the beginning of November, 2 days after the election. Or day after.
I'd say September. I'm going to go with September. September, just 0.25%. I still believe that if economic numbers slow or kind of stay stable, and I'm going to go with that just being the base case for me. The lower to 0.25%, but I think that the language will start to change for maybe the first part of next year.
Okay.
So I think it's more in the language that will start to change. And they will keep with that than the actual actions that are going to happen in the
so they are not going to cut in September.
They will cut. They'll cut, but they're not going to surprise us to anything different than what we've been thinking the last month or so.
I think JP Morgan agrees with you, if I recall correctly, and some people are still calling for 2 rate cuts. That would require some slowing growth here. Okay, well, I think we can all agree that in July they're not going to do anything.
Yeah.
Right. So that takes us to September. I think they get to September, and I still don't think inflation has gone down enough that they're going to cut. They may talk dovish, talk about rate cuts, or we're progressing towards the goal or something, but they don't actually cut. Also because they're worried about being accused of influencing the election.
You think that's why they won't do it? I actually picked September because I think that they were like 0.25% kind of been baked in, and they're doing it just because that they are doing it before the election. Actually, that's kind of why I chose it.
Okay. Well, yeah. I think they'll talk about doing it, and I think markets will respond to a lot of dovish talk in September, but they don't actually pull the trigger until November, and then maybe we'll get a November and December cut because they're catching up because maybe they're late and we're starting.
So you're saying November, December. So you're saying quarter and a quarter?
No, I think I really, my heart of hearts thinks one cut this year and two next year, maybe. But if they do two, it'll be November, December. I think the Fed is never early, never. They're always late. They don't want to influence the election. I think it's November. And so
are you saying 2025, like you're saying 2 rate cuts, but like a quarter each, or are you taking larger cuts at like a half?
Who knows? I mean, kind of depends on what's going on with the economy. If we suddenly have like 6% unemployment and it's really starting to crank, I think they'll chop. Look at this. Look at what we're looking at right here. The 2024 to 2026 rate hike cycle. I know this was like 2008 that they were dealing with in Lehman Brothers failure, but look at the increases and then look at the cuts.
Yeah. Same
thing with between 2015 and 2020. Now, again, global pandemic, but they were cutting before the pandemic. They raise rates and then start slashing, and they could cut in between meetings. They could cut a 0.5% a meeting, bang, 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 and bring it down really low. So I think they can cut quickly.
Okay, so
they're not going to hurry to cut early.
From like an investor standpoint, you know, if you own bonds, again, like we said, bonds will go up if interest rates get cut. So sometimes you see these falls in the previous cycles that get cut fast. Those would lead likely to the bonds going up pretty nicely because the rates fall pretty drastically and quickly. The problem is that both of those instances, there were major issues going on. And so you don't want those situations to happen where interest rates need to fall off the edge of a cliff, because that probably means that there is something drastically wrong happening in the economy.
Yeah.
Something that might need to be fixed.
Yeah, well, so rates were starting to get cut before COVID. They fell off the cliff after COVID.
Yeah, no, that's what I'm saying. I'm not saying the reason to lower interest rate. I'm saying, but when if they were to fall off the edge of a cliff and drop by like a 1% at a time, or 2% over a couple meetings, that probably implies that something something bad's happening in the economy.
Yeah, but I think even if they're being cut, you can look. In 2020 bonds, but before COVID, in 2019, rates were being cut, and the total bond market return for the ag was up 9%. So this is not COVID; these are just rate cuts.
Sure. Yes.
And they were up. Now the year before, interest rates in 2018, interest rates were going up. Bond market was flat for the year. They started getting cut. Bonds were up 9%. No COVID, just on cuts. So hey, we'll take it. You go back 2008, financial crisis, bonds weren't down because rates were being cut. In fact, bonds even weren't down when rates were being raised before that. But I think really there's going to be there's some whiplash that's waiting to happen here, coming from these lousy years that we've had. In 21, 22, 23 was up 6%. And now here we are in 24, essentially flat after being down 4% at one point during the year. I just think there's some potential. It's not going to take a whole lot of rate cutting to have bonds come back. And if I feel like as we talk with people are sick of waiting. Right.
Well, you look at your,
it's been years.
Your performance reports, and you go to the bond section, and again, it's very much like what people do with 401k statements at the end of the year, where they're looking to reallocate, and they look through the performance of the 12 options on their 401ks, and look at the bonds, and they look at the stocks, and the stocks do really well, and the bonds are just for another year haven't done a whole lot. And so I get it. We're patience weighs thin, and I do think though that there's a potential in the second half of the year for the bonds maybe to really make up some returns, and it can come from just the language of the Fed starting to change, similar to what happened in November, December of last year. Bonds rallied off language.
Absolutely. And diversification, I think one of the other reasons everybody's impatient is because diversification didn't help. Look at 2022. Bonds were down as low as the ag was down as low as 17% on the year and ended up finishing negative 13%. Also, stocks were terrible. And so if you own bonds, you got punished in 2022, but you didn't get all the benefits that come from owning stocks on the good side, right? It just, you were either barely up or down a lot. And I can see where that's going to wear on everybody. But it's when you grow so impatient that you throw in the towel that the thing that you've been waiting for comes to pass.
Yes.
So, you know, even when stocks are down, you say, oh, I can't take it anymore. And you capitulate and you sell. And then you look back and you're like, damn,
I definitely
why did I sell in February of 2009? You know, like,
yeah, I think that on the bond market, we're going to get, you know, very shortly back to a place of normalcy where it is that diversifier, right?
Yep.
You have bonds there. The bonds do help protect you. You know, if the markets were to go down, if we were to have a recession, those bonds would likely get traction to potentially make some money, even when the stock side is down. I think those times are going to come back to us.
Yeah, you'll even get rewarded. Not even just diversified, but rewarded. And
right.
It could come on both ends, especially rates start getting cut for real. Bonds may not be the only thing going up, or the ag. Okay. So there's the case for owning bonds or not abandoning bonds, especially if you're a conservative investor. Ryan, what's on your mind other than trying to get some sleep?
I'm going to go back to the topic of Italy. So, you know, you talk to people.
Tell everybody what we're talking about. I think.
Okay, so I was family vacation. We were in Italy for 2 weeks. We had a great time. You obviously, when you come back, people ask, you know, how's your trip? I think the second question, because it was Italy, people come back and say, how was the food? And that's where I will kind of diverge and say, you know, to me, I would say it was a bit of a disappointment. Not that it wasn't good, because I would say it was good. I just had maybe higher expectations that it was going to be great. You know, you think of the places that you can go to in the world, and I actually think of very few where you actually think, man, you know, the food there should be really, really, really good. And my wife does, I will say, she's into food. She spends a fair amount of time before trying to like plan out places to eat. And we had some good meals. Like we had probably 2 very good meals. Everything else was, I say, fair to good. And I just, at the end of the day, I think I had higher expectations of what we were going to be able to eat there. So that's kind of what I'm thinking about. Just, you know, little disappointing, but not to say it wasn't good. It just didn't meet my expectations overall. Yeah.
Well, I mean, Italian food isn't what Americans think. It's, you know, it's not Olive Garden, all you can eat breadsticks, right? It's like simple ingredients and fresh.
It's simple ingredients. It was good. Yeah, it was
right. Like a noodle is just flour, egg, and water, right?
Yeah. What did you say?
A noodle is just flour, egg, and water made by someone's nonna in the back of a little pasta shop, right?
Yeah. No, we took a cooking class too. We made some pasta.
That's very cool.
But yeah, it was just, you know, it was good overall, and maybe it was more of my expectations coming in. I mean, if you go to London per se, you know, my expectations are going to be different, you know.
Sure.
I don't have that high expectation for the food. And so maybe I set the bar too high for myself going into this.
Oh, okay. Now, I've heard some people come back from Italy thrilled. Others are disappointed. It probably depends a lot on your style. Someone said too many people smoked. I had a client that said there were too many.
That's fair. A lot of people smoke.
Yeah. So
yeah. Yeah. But overall, I would 100% recommend going to Italy. Expect it to be really busy. Before, you know, I hear that there's not really a great time to go. There's better times to go, but it's generally busy throughout the year. Obviously, the summer it's going to be more packed, which it definitely was.
Sure.
But yeah, it was beautiful. It was good to see the things that were out there. Trip definitely was an A+ overall.
Oh, good.
Yeah.
Well, I feel like I'm the only one not traveling this summer, or at least traveling abroad. Like everybody's going everywhere, but us. But we just got our passports.
Oh, cool.
So my passport was lost, so I had to redo mine. Jennifer's passport was expired and had her maiden name on it. So there were a whole bunch of reasons she needed to go redo her passport. Then we got passports for the kids. So we are not going abroad this year, but it's almost like when the passports show up, and they just did. Yeah, it's almost like buying a lottery ticket. suddenly your mind goes, what could we do? Where would we go? The world's at our feet. You know, where should we go next? So there's a lot of discussion in our household.
Well, I'll say this too. So the good thing about that, getting the passports, is you kind of start the clock, right? Because your kids' passports are only good for 5 years. So
I didn't know that.
Yeah. So you gotta make use of it if you start that clock. I mean,
no, we will. We definitely will. The question is like when, and so we have some space in October where we might be able to travel. And so my wife's thinking, oh, maybe here, maybe there. I hear October and travel. I'm thinking Oktoberfest all the way. There's got to be something more going on there. Like, are we going to London? Well, is Wimbledon going on? We want to go to Montreal? Well, let's go when the F1 race is happening. You know, I need more. I need more than just sightseeing. But we'll see. I will say though, that's secondary. The thing that's primary going on in our house right now is did I tell you this? We got a kitten.
Oh, okay.
Neighborhood cat adopted us.
Okay.
And we were loving this cat, and then he went back to his family. So
really? Okay.
Yeah,
I saw the cat when I was at your house a few weeks ago.
It was great. He's awesome. Awesome. Come to find out, his name is Roger. I think he hangs out more at our house than the neighbor's house. And when I say the neighbor, the neighbor's house is really far away, but he comes and hangs out at our house. So anyway, he took off. So we got a kitten, and so the kitten just got fixed and is requiring a bunch of time and care and stuff. I'm not used to having tiny animals. The kitten's name is Coco. So between Roger and Coco, you can figure out what sport we play in our family, right? So anyway,
easier than a dog though, or easier than a puppy.
Oh my God. I've never owned a cat. Okay. I've never had a cat.
Yeah.
Only had dogs. Dogs are, I mean, don't get me wrong. I love dogs, but got to pick up after them, and they're needy and want to be pet and walked and all the stuff. And they're great for company, but the cat just chills.
Yeah. Does its own thing.
Yeah. So I'm actually, I've never been a cat. It's not that I was anti-cat. I just never had a cat. Wasn't a cat person.
Yeah.
Not bad. You know,
that's good. That's good.
Yeah. So anyway. All right. Well, let's leave it there. Ryan, we'll have another couple of these here in July. And before we do the next one, we've got 4th of July. So we'll be off. Markets are closed early on July 3rd, closed on July 4th. So our hours here at the office will correspond with that. If you have questions you want to submit to us that you want us to tackle on this podcast, email us at info@fordfg.com and we'll get to those. Also, as I mentioned kind of at the open, subscribe, whether you're watching on YouTube or listening on Spotify, Apple Podcasts, anywhere else. Subscribe to the podcast so you don't miss one. And when we come back, I expect you to have all 10 fingers, right? You're not going to blow off a hand doing fireworks.
Hopefully.
Hopefully. That's the spirit. All right. Very good. Ryan, till the next one.
All right.